Hello, and welcome to The Explainer. If you are a focused learner looking to kind of demystify complex systems, well, you are absolutely in the right place. Today, we're going to untangle what often feels like a completely impenetrable web, and that is the global banking system. By the end of this explainer, you'll have a crystal clear understanding of exactly where banking came from, how it operates today, and where it's heading tomorrow.
Okay, let's dive into this. To truly grasp the whole international banking system, we first need to look at its sheer, unbelievable scale. Just the top 10 banks alone account for roughly 25 trillion US dollars in assets. 25 trillion! That is just a staggering amount of wealth concentrated in a tiny handful of institutions.
Which naturally leads us to ask, how did banking get so incredibly complex? I mean, today, we're looking at a maze of more than 30,000 different banks worldwide. But originally, the entire idea was simply to make life and commerce easier. To understand this modern beast, we need to completely strip away all that 21st century complexity and look at its absolute original purpose.
Section 1. Born on a bench.
Let's travel back to the 11th century. Italy was the bustling, vibrant center of European trading. Merchants from all over the continent would travel there to trade their goods. But they hit a massive logistical hurdle. There were simply way too many different currencies in circulation. Imagine being a merchant in Pisa dealing with 7 different types of coins, constantly calculating and exchanging your money just to do basic business. They actually did this exchange work outdoors, sitting at simple tables. In fact, the Italian word for bench is banco. So yes, the titans of modern global finance literally owe their name to guys just sitting on outdoor benches. And this brilliantly illustrates how that simple physical necessity evolved into a highly sophisticated network. You see, the dangers of traveling long distances with heavy sacks of coins, the constant threat of counterfeit money, and the sheer difficulty of getting a business loan basically forced the model to adapt. First, home brokers stepped in to provide credit directly to businessmen. Then, by the 13th century, Genovese merchants had developed early forms of cashless payments to completely bypass having to transport physical money. Eventually, this grew into a continent-wide network that was powerful enough to hand out major credit to European kings and even the church.
Section 2. How banks actually work.
If you strip away the fancy marble lobbies and the high-tech trading floors, you're really just left with one reality. At their core, banks are simply in the risk management business. That is their absolute primary function. They exist to take funds that are just sitting unused by savers and actively turn them into funds society can use to build and create.
So the crucial point is how this engine actually runs. It's an elegantly simple, yet deeply calculated 3-step risk model. Step 1, people deposit their unused money. Step 2, the bank pays those depositors a small amount of interest, kind of as a thank you. And Step 3, the bank takes that pooled money and lends it out to other people or businesses at much higher interest rates. The difference there is their profit. Now, it's a calculated risk, of course, because some people will inevitably default. But this exact process is the fuel that allows regular people to buy houses and massive industries to expand.
Now, while lending is obviously the core engine, modern banks have highly diversified. They generate revenue through a huge web of secondary channels today. We're talking fees associated with saving deposits, the massive credit card business, trading foreign currencies, securely holding assets as custodians, and managing massive, complex cash flows for global corporations.
Section 3. The 2008 financial crisis. The root of this historic 2008 collapse was actually a massive shift in priorities. For decades, traditional banking was all about being steady providers of long-term financial products. It was predictable and it was beneficial to society. However, during the boom leading right up to 2008, a lot of major banks totally abandoned that traditional role. They pivoted. They started chasing short-term gains that carried exponentially higher risks using financial constructs so incredibly complex they were barely comprehensible. And all of this was designed to earn executives rapid, high-stakes bonuses. This shift essentially turned banking into gambling. Institutions like Lehman Brothers started handing out high-risk housing credit to basically anyone, completely regardless of their actual ability to pay it back. When those borrowers inevitably defaulted, it triggered a cascading collapse of the housing markets in the US and parts of Europe. That collapse caused stock prices to absolutely plummet worldwide, igniting a severe, full-blown global banking crisis. We literally cannot overstate the human and economic toll of this event. Hundreds of billions of dollars quite literally evaporated into thin air. Millions of hardworking people lost their jobs, their homes, and their life savings.
Almost overnight, bankers went from being highly respected figures in the community to some of the absolute least trusted professionals in the world. The aftermath of all this saw a really complex push and pull between governments and the financial sector. On one side, governments in the US and the EU instituted massive taxpayer-funded bailouts to purchase bad assets and prevent systemic bankruptcy, while also setting up emergency funds to absorb any future shocks. But simultaneously, banking advocates lobbied incredibly intensely. So, while some new regulations were definitely passed, many pieces of much stricter legislation proposed to govern the industry simply did not make it into law.
Let's move to Section 4, the future of finance, and see how this builds into the alternatives gaining ground today.
Because of the massive 2008 fallout, people obviously begin looking for alternatives, and one of the most significant actually isn't new at all: credit unions. You see, traditional banks are built primarily on profit maximization for their shareholders, but credit unions, they are cooperative initiatives completely focused on shared value. Originally established back in the 19th century to help people circumvent predatory credit sharks, they provide the exact same financial services as a regular bank, but they are democratically controlled by their own members.
Because of that, their goals look totally different. They are focused on helping members create opportunities, start small businesses, expand farms, build family homes, and actively invest profits right back into the local community. Because their focus is strictly on shared member benefit rather than chasing executive bonuses, they manage risk much more conservatively. And that actually explains why credit unions survived the 2008 financial crisis far better than the major traditional banks did.
We're also seeing a massive shift in the corporate finance world with the rise of new investment banks. These newer institutions are essentially flipping the traditional model on its head. They charge a flat yearly fee for their services, and crucially, they refuse to take commissions on the financial products they sell. By completely removing that commission structure, they finally provide the motivation for bankers to act genuinely in the best interests of their clients, rather than just pushing risky products to earn a fast payout.
Now, what's really interesting about this slide is how technology is stepping in. Crowdfunding platforms like Kickstarter allow us to essentially circumvent the traditional banking middleman entirely. Instead of one single bank taking on all the risk for a project, a creator gets funding from a huge group of small, everyday individual investors. For you, the investor, you actually get to fund ideas you truly believe in. But more importantly, it spreads the risk out so widely that if a project does fail, the financial damage to any single person is incredibly limited.
And last but certainly not least, we have the incredible rise of microcredits. These are very, very small loans, primarily handed out to individuals in developing countries. Historically, traditional banks completely ignored these folks, basically deciding that their small loan requests just weren't worth the bank's time or administrative effort. But microcredits step in to provide that vital access to capital, allowing everyday people to start microbusinesses and literally escape poverty. What started as a tiny, community-driven idea has now evolved into a highly successful, multi-billion-dollar global business. It proves that investing in everyday people actually works.
As we wrap up this explainer today, I want to leave you with this thought. Traditional banking might not be exactly up your street, especially after looking at some of its history. But the fundamental role that banks play, taking unused funds from savers and getting them into the hands of the people and businesses that actually build our world, is absolutely crucial for our society. It is an essential function that simply has to be done for our economy to survive and to grow.
So the final question for you to ponder today is this: who will do our banking in the future? The function itself is completely necessary, but the institutions we choose to actually trust with our money, whether that's a traditional megabank, a local credit union down the street, a flat-fee investment firm, or a community crowdfunding platform, well, that is entirely up to us to decide. Thank you so much for joining me today. Keep learning, keep asking questions, and I will see you in the next explainer.